Hi folks, this is Craig, the options linebacker, and this is the weekend report for Sunday, December 6th. Well, the market's been chopping around so much for the last month. All anybody wants to know is whether the market's going up from here or whether it's going down. So let's compare and contrast the two ways that this can go. First of all, let's go over the bullish case. Now, the first point for the bullish case of prices going higher from here is that cheap money is going to be with us for some time to come. And the Fed has made that very, very clear that we're going to have cheap money into the financial system for at least the next 6 to 9 months. Now, this is not money that you and I are going to see. This is money that Goldman Sachs and those types are going to have access to. And really, this is the basis for this strong rally that we've seen since March. So cheap money is going to be here for some time to come yet. This supports higher prices. The second point that we can make for the bullish case is that stocks have consolidated over the past month plus and are ready to explode. Now, we don't know what direction, but it certainly could support a move higher. And we can see this on the S&P 500. Anytime that you have prices showing literally railroad tracks here, they're storing up energy and they're getting ready to move. And in this case, this is not quite a bull flag. This is more of a horizontal consolidation pattern, but it wouldn't surprise me to see it burst out sometime in the next week or two. Something else that we're seeing is small caps with the Russell 2000 may be changing polarity again. Plus, Dow theory is also confirming now with the transports. So here's the Russell chart. It's made 1, 2, 3, 4, 5 waves to the downside, and now what it's looking like it's doing is making wave 1, 2, 3 to the upside. So this price is above the 61.8% fib. It's above 600. If it's able to gain traction here, this will be wave 3 to the upside. And as we mentioned, we're also seeing a confirmation in Dow theory. When you have the Dow making higher highs and higher lows as they are, what you also want to see is the transports having the same pattern. If the Dow industrial companies make the product, then the transports have to ship it. If both are moving higher highs and higher lows, then both are in uptrends and both are confirming the fact that things are moving higher. What we've also seen for months now is this continual cycle of shorts trying to pick the top, and as less bad news comes in, they're forced to cover, and this is what's creating these constant little rallies that keep popping up off the bottom. This is sustaining the rally to the upside. And the last thing for the bullish case is this time of year, very traditional for us to have a little bit of a Santa rally into the end of the year. Now let's look at the bearish case, the case that we may see prices drop from this point. The first point on the bearish case is that the S&P has hit that 50% bear market retracement right around S&P 1121. And this 50% retracement, as we went over in videos a few weeks ago, has really served as the top for most of these rebound rallies from major recessions. Second point on the bearish side is that we're seeing diverging internals. We're seeing new price highs coming in with fewer stocks making those higher prices. So that means that this market is just churning higher on fumes and not real strength. And we can see this if we look at the chart of the New York Stock Exchange advancers, where we're going higher in price in time here on lower number of advancing stocks. The next point is that the energy and financial sectors, which are really the engines behind the S&P 500, look kind of weak right now. Again, these sectors have the highest weighting of the S&P 500. You can see this in the energy. Energy looks weak. It's made a serious low on Friday, although you can make a case that this is just a bull flag and a breakout above this trend line would be really strong. Same thing with the financials. The financials are making lower highs, but if it breaks this trend line, we could be in for an upside pop. But right now they do look weak. Next, for the bearish cases, you have to say the S&P 500 1120 resistance looks really strong and has showed a lot of strength over the course of the last month. Here's the S&P, here's that 1120 line up here, and you can see how strong that's been. That just to get over 1100 was difficult, and this 1120 area looks even tougher to get past. And lastly, for the bearish case, we've been talking for some time now about how equities have been running in a reverse correlation to the US dollar index, and the dollar just moved much, much higher on Thursday and Friday. In fact, it's broken above this descending trend line on Friday and showing massive amounts of bullish divergence. and a fairly strong base. So we'll see whether or not this move sticks. But if this does vault higher from here, which it very likely could, especially with the jobs report showing strength in the underlying economy on Friday, then this may have a very negative impact in the short term on U.S. equities. So there you have it. There's plenty of ammunition on both sides for the stocks either to go up or to go down from here. And for that specific reason, I think that's why they've been stuck in a range for the better course of a month. But to be honest, I don't really care. This is why we play non-directional strategies here at Options Linebacker. And our December positions, we have tons of room on the downside position. We're just going to let this one expire. And our topside position is a little tight, but it's right on the verge of profitability. And we have a couple of nice hedges in place right now with a butterfly showing profitability, as well as a 105-105 synthetic hedge trade to the upside, which is also profitable. So this is why we play these hedge trades in addition to playing a neutral strategy such as the Iron Condor. So I can shut down the entire upside mess on Monday morning, take all my risk off the table for the upside. We've got tons of room to the downside to move and ensure another profitable month. That's 4 straight months in a row we pulled a profit out of the market in some of the toughest trading conditions that people have seen in a long time. Now, while we generally play non-directional strategies like the Iron Condor, we're also playing some directional strategies as well too. If the market's just going to go ballistic like this, then why fight it? Let's play some directional strategies to kind of round out our portfolio. And so one of the ones that we're looking at here is the 8 and 21 EMA cross. So we did have an upside cross here, and what we're looking for is to take the price entry as the price comes back down to the 8 EMA. Almost got there, but we did get an entry right here, and right now we took 50% of the position off as it got to the upper Keltner, and we're holding the second half of the position long using that 21 EMA as a stop. So right now we're making money on this trade as well too. So that's it for this weekend, and thanks for watching. Make sure that you tune in next week for more in the markets. Really quick before you go, we just released a new product called Traders Fast Track, which is an inexpensive trading success program. If you go to the link in blue, we have a special offer where you can get our premium daily newsletter free for a whole month at optionslinebacker.com/fasttrack2. We also have some brand new free stuff for you. When you go to that Fast Track page, you can sign up for a free monthly newsletter dedicated to how successful traders operate, our Fast Track newsletter. You can also instantly download our brand new ebook for free, Technical Analysis for Options Traders, which shows you how a few simple yet powerful reads in the market can help improve your options trading profitability. Good trading. See you next week.